Okay, Happy New Year and welcome to the first IpsoFacto Investor live investment webinar. It's great to see so many of you joining us. My name is David Little, founder of IpsoFacto Investor, the investment advisory service for private investors, FCA regulated. We're passionate about giving good investment advice to private investors who want to manage their own investments. Please do, if you haven't done so already, go to our website, ipsofactoinvestor.co.uk, and try our free two-month trial. We'd love to get feedback, so we'd love to hear from you. This evening, I'm going to talk about the investment outlook for 2017. The presentation will last about 20 minutes, and at the end, there will be a Q&A session. But please do send in your questions as we go along. It'd be great to get a conversation going and talk about the issues that really matter to you. But just before I go into the presentation, I thought I'd talk about a few financial planning matters that are coming up. Obviously, at the end of January, those doing self-assessment need to have done their 2015-16 tax returns online. So that's a deadline to bear in mind. Also, in the current tax year, that's 16-17, this is the first year where the new tax on dividend income over £5,000 applies. So remember, everyone gets a £5,000 tax-free dividend allowance, but above that, for income that's outside ISAs or SIPs, there is a 7.5% tax for basic rate taxpayers and a 32.5% tax rate for higher rate taxpayers. So there may be tax planning opportunities whereby you can reduce tax, either by swapping investments between partners or couples, or else by selling investments. But do bear in mind there may be capital gains tax implications. It's also, of course, the ISA season, and we're coming up to the end of the tax year. So make sure you've used your £15,240 ISA allowance for 2016-17 where relevant. It goes up to £20,000 next year. And finally, on pension contributions, everyone can contribute up to the lower of their earnings level or £40,000 into a pension fund on which the government gives you tax relief. So just a few planning points to bear in mind as we come to the end of the tax year. So now turning to the presentation. I'm going to talk about, just to set some context, the issues, the big picture issues that really matter in investing. Then I'm going to talk about what happened to investment markets in 2016. What were the main factors behind this performance? Then looking forward, what are the starting valuations? What do commentators expect? What may be the important factors in 2017? And how should we react as investors? So what really matters in investing? Uncertainty, understanding the role of uncertainty, the importance of valuation, and having the right approach to risk and diversification to suit your objectives. Uncertainty. I don't want to lose your attention this early on in a presentation supposed to be about the outlook, but emphasizing the self-evident truth that the future is uncertain is important to successful investing. Keynes, the great economist, was a Cambridge maths scholar originally. He was also, as it happens, a very accomplished investor, running the King's College Cambridge Endowment Fund for many years. Keynes understood that economics is not really a science in the sense of being mechanistic, and the same applies to investment. Keynes's economic theory was built on this uncertainty. And for example, his general theory, written in 1936, goes a long way to explain what has happened in the global economy since the financial crisis. He understood that economics and markets are often about psychology. People matter and people are unpredictable. Markets are imperfect. And as Keynes put it in his 1936 general theory, our knowledge of the factors which will govern the yield of an investment some years hence is usually very slight and often negligible. So, valuation, the importance of valuation. In an uncertain world, the one certainty we can attempt to build on is around valuation. Markets often get carried away, both positively and negatively, so they overshoot. The bedrock of valuation provides some protection against this. That is why at IpsoFacto we pay a lot of attention to the facts and figures around fundamental valuation. But also in assessing valuation, we need to be aware of where we are, to the extent we can know in the business cycle. Risk and diversification is all about setting objectives to suit your circumstances and applying a systematic approach. At IpsoFacto, we have run a 30-stock equity portfolio since 31st of March 2012. The portfolio is selected by a data-driven methodology to which we apply a consistent set of rules. For example, no more than 3 holdings from one FTSE sector, no more than 5% of the total in any one stock. Our aim is to outperform the FTSE All-Share, hopefully with lower volatility. The returns so far have been very satisfactory, with capital and income gain of 58.2% after estimated costs, versus a return of 43.9% from the FTSE All-Share. So this is showing that this kind of disciplined approach can work. So turning to the 2016 investment performance, the UK stock market, the FTSE All-Share, was up 12.5% in capital terms over 2016. It outperformed the US, which was plus 9.5%, Germany 6.9%, and Japan just 0.4%. But over 5 years, of course, the picture is quite different. Japan is up 126%, Germany 95%, the US 78%, and the UK a measly 28%. But why did the UK market manage to do so well in 2016? As we'll see, a lot of the story is about the exchange rate and the oil price. So this slide shows that the UK market outperformed the big emerging markets of India and China in 2016, but also that yesterday's dog, Brazil, which had a very bad 2015 and earlier, can become today's winner, and that despite manifest political and economic issues. So Brazil is the top line in that graph. So turning to sectors, we can see from this slide that the overall gain of 12.5% in the FTSE All-Share hides quite significant divergence between some of the different sectors. Oil and gas and mining, the two top lines, were clear winners, whereas the more domestically focused sectors such as household goods and home construction did not do so well. This was partly, of course, a Brexit issue, but the trend, whilst given added momentum by the referendum vote and the depreciation in the sterling that took place following it, can be seen in the early part of the year as well. So we can see that oils and mining, the industrial sectors, performed quite well. So now turning to two of the largest companies, well, the two largest companies in the FTSE All-Share, Shell and HSBC. These two companies make up roughly 14% of the All-Share. So whether you own them or not had a big effect on 2016 performance. And that is why you'll find that many fund managers have underperformed in 2016. Even some of the famous ones like Neil Woodford with his equity income fund, which is £9 billion in size, probably underperformed. And one of the big reasons for that is that he didn't own Shell or HSBC. If we look at the previous year, 2015, the picture was quite different. Value managers who liked the cheapness of these large cap stocks suffered as they just got cheaper. Over 2016, the pound fell by 19.4% against the dollar. Sorry, by 19.4% against the Japanese yen, 16.7% against the US dollar, and 13.8% against the euro. And whilst the mid-year referendum gave impetus to sterling weakness, most particularly against the dollar, again, we can see some weakness had already been evident earlier in the year. Currencies may again be crucial in 2017. Interest rates. No story of 2016 would be complete without considering interest rates and government bond yields. Remarkably, Japanese and German 10-year government bond yields went negative during 2016. This is unheard of and madness in our view. So when you were buying government bond yields that were negative, you were guaranteeing to lose money. 10-year yields, the risk-free benchmark, are crucial to investment markets. So if you look at the top line here, will that upswing in the US yield continue? Are we returning to some sort of normality? This will be a very important theme for 2017. So just to summarize, what was really behind 2016 investment market performance? The US economy began to motor. GDP rose at an annualized 3.5% in Q3, finally perhaps breaking off the chains of the financial crisis. Central banks continue to be supportive, but were running out of powder. Had interest rates bottomed? This was the big question. Oil and commodity prices staged a strong recovery. As for politics, whilst producing unexpected results, at least uncertainties were somewhat resolved. Sterling took the strain of Brexit, whilst investors soon changed their mind about Trump, focusing on the business-friendly aspects rather than the risks. In particular, investors welcomed what seemed like a new dawn, the potential for fiscal policy to drive forward what monetary policy could not. Above all, investors put money to work in equities. So, valuations. As we said earlier, valuations are an important factor in determining investment outcomes over the longer term. Based on the MSCI indices for various countries and regions, we have set out on this slide some of the basic valuation drivers: dividend yield, historic price earnings, forward price earnings, and price to book. This table is ordered by dividend yield, with the highest at the top. Of course, there may be some distortions in these figures, and this shouldn't be taken as gospel. And the PEs in particular can be distorted and need to be treated with caution. Our own equity model portfolio, that is the UK 30 stock model, has a trading PE, historic PE of 14.5 times and a dividend yield of 4.4%. So it's considerably cheaper than the UK market shown here as a whole. On this slide, we have ranked each country and region according to the 4 factors on the previous slide to come up with a total score, lowest being cheapest. So here, emerging markets in general come out as having the most attractive valuation, whereas the US is the most expensive. There are, of course, reasons for this. Emerging markets are deemed more risky, partly as a result of fear of President Trump's potentially protectionist policies. So what do markets expect? What is the consensus outlook for 2017? Well, the consensus, by and large, almost by definition, tends simply to take the existing situation and project it out a little. Hence, it is most often rather wrong. Pundits were probably polled in mid-December for their FTSE forecasts and took the then current level and added 5 to 10%. Well, we're already above the mid-range here, with the FTSE closing at close to 7,300 today. Now, that of course doesn't mean that these forecasts may not be right, but there is evidently some chance that the markets will change quite a lot between now and the end of December. But it can be useful to understand what markets are anticipating when we try and see how to position ourselves. So what may drive markets in 2017? Center stage, as always, is the US economy and what its performance means for the dollar and US interest rates. But we are almost certainly into another year where politics is influential, even if the 2016 political outcomes did not have the expected results. Of course, there is likely to be an interaction between all these points, so nothing is simple. For the UK, watching the strength of the pound will be an important indicator of the international assessment of our economic future. So I had a question here about inflation and why it doesn't appear on the consensus outlook. I mean, I think that inflation interest rates are strongly linked. And indeed, we could have put inflation together with interest rates. That generally, in the US, people are expecting inflation to pick up, and in the UK as well. Partly, of course, in the UK as a result of the depreciation in sterling. But that's a fair point. Inflation is going to be a very important aspect of how people are looking at 2017, and indeed, are we at the point that we've finally got out of the torpor induced by the financial crisis, and we're going to see some sort of return to normality. So inflation rates at or around the 2% level, which is generally the central bank's target. So what can we conclude about markets in 2017? UK markets, whilst not cheap, are not excessively expensive either. Banks and oils can still motor and drive the market forward. But there is Brexit, which is a potential challenge to more UK domestically focused stocks. And we have to watch sterling carefully. But one of the reasons why we think UK markets are not that expensive is looking at the dividend yield. And at the moment is well over 3.5%. The average since December 1998 has been 3.3%. That's the yield on the FTSE 100. So at the moment, we're in a situation where the yield is still above the average level, which implies, other things being equal, that markets may be below average valuation. Longer-term investors who can stomach volatility should have at least some exposure to emerging markets, particularly Asia Pacific. The course of US interest rates, whether led naturally higher by markets or preemptively raised by the Fed, will be crucial. Bonds, at least government bonds, remain very unattractive when inflation may be on the rise, as we were talking about earlier. Equity markets in general have had a good run, and whilst there may be positives from Trump for the US economy, the risks have also surely increased. In terms of data points, if you just watch one thing other than the level of stock markets, it should probably be the US 10-year yield. If it is stagnant or falling, it is probably bad news. If it is rising, that may be good news if it reflects stronger real growth. But it could be bad news if it reflects the Federal Reserve raising short-term interest rates too quickly to head off an inflationary threat. So where should we invest? It's all too easy for those of us who look at markets and news the whole time to get carried away with it. But it does seem to us there is a risk that nationalism and protectionism may be increasing factors in a way they have not been for a very long time. We simply don't know where this may lead. Of itself, this warrants some caution. Add to this that we have had a pretty decent run in most equity markets, and common sense dictates a more cautious approach. So we say be nimble and diversified. Overall equity allocation should be lower than target or average. Within equities, we favour UK, emerging markets and Japan. And within the UK exposure, go for large cap rather than mid and small. Emphasise dollar assets, not necessarily dollar equities, US equities, but look at dollar money funds. And if we see bond yields going up in the US, then looking at US denominated bond funds could be interesting as well. Consider inflation linked. For example, there are global ETFs which have quite a large dollar exposure. and possibly a small gold exposure, but we would tend to favor gold miners rather than the physical gold, although they are much more geared, obviously, to the gold price. And finally, there's nothing wrong with holding an above average cash position when the future is even more uncertain than usual. Do pay attention to this warning, risk warning. Investment is risky, particularly in equities, which are volatile instruments. And now we'd like to turn to the Q&A session, and we've had a few questions coming in. Some other questions that have come in. One is about US interest rates. Why are US interest rates so important? Well, this is obviously quite a big issue, and partly reflects the fact that the US dollar is effectively the world's currency. There are many financial transactions that are carried out in dollars, and it is the one currency that is almost universally acceptable. It's also the case that a lot of emerging companies and countries have borrowed in US dollars. So if the dollar goes up, as would be implied by interest rates rising, then that can have an effect of causing those companies and countries to have to pay more for their borrowing. Of course, there's the other side to the coin, which is that US interest rates going up would usually reflect a stronger economy in the US, and that may well be beneficial globally. But it's definitely the case that we need to watch US interest rates. And as I said earlier, if they reflect a stronger economy, a stronger real economy, then that is good news. If, however, they are really going up in respect of the inflation threat, and the Federal Reserve in the US is putting up interest rates, then that can be a problem. But thank you very much for your question. So we've got another question here. What is your view on defensive stocks against value stocks in 2017? Well, that's a great question. Thank you. It's been an interesting period for looking at defensive value. To some extent, what we've seen in the market rise over the second half of the year in particular is value stocks performing and defensive stocks, or at least those bond proxies, not performing so well. This, I think, will be determined, the outcome here will be determined as so much else by the course of interest rates. And if we continue to see a stronger US economy, then I would expect to see value stocks to have a reasonably good run versus defensives. If, on the other hand, obviously we get a stalling in the US economy, or we get some big event or some political disruption, then you should expect defensive stocks to do well. But the so-called bond proxies, the national grids and the tobacco companies, which for years have done very well, did become quite expensive, and you did see them sell off quite aggressively during the closing of 2016. And in fact, such was the sell-off that we actually liked Imperial Tobacco and added that to our equity portfolio, as it happens. So I've got another question here. Please, would you expand on your bullet point, market timing is not important? The bullet point wasn't actually that, it was a question of whether you should market time or not. And we actually believe that market timing can be important, and we have an objective methodology for looking at asset allocation so that we can indeed get the best risk return for our investment in different assets. So I think market timing is important, but there is a contrary view that just and you can stomach volatility and you don't need to realize your investments in the short term, then don't worry about market timing. We have another question here. I'm a fund-based investor who has done well from bond proxy funds in the past few years. Are these kinds of funds equities likely to continue to do well, or is it time to shift into value special situations? Well, that's, I think, really goes back to that previous question about defensives and value stocks. We do think that value stocks have a good chance of performing, but clearly that's going to be a question of how the global economy performs. By and large, as in everything, it will pay to stay diversified. So in our model portfolio, we do have some defenses, we have some value stocks, obviously. So I think it is a time to mix and match. So we've got another question which is similar to that, about investing in bond proxies as opposed to bond funds. I think myself that I would rather be in equities generally and a mix of equities than investing in bond funds at the moment. Although there is a case for corporate bond funds, although the expense ratios tend to be quite high in terms of the current yield on those funds. But as an alternative to cash and as an alternative to parking your money, high quality corporate bond funds, I would almost prefer to the bond proxies, because really what you're trying to do is avoid equity risk. We've got another question here about wealth preservation funds. These tend to have a decent slug of index-linked bonds in them. Is that still a valid strategy for preserving wealth, given no one likes the outlook for bonds, even index-linked at the moment? Well, that's a great question. There are a lot of those funds. One thinks of personal assets, capital gearing, those sort of investment trusts, as well as the Troy funds. That, and it's true actually of the Investec Cautious Managed Fund, for example, tend to have quite a lot in index-linked bonds. The trouble with index-linked bonds, it seems to me, is that they're really a mixture of a very long-dated, or tend to be very long-dated bond fund, which therefore has quite large interest rate risk, and the inflation proofing that comes with the indexation. When we've looked at this in the past, we have found index-linked, UK index-linked at least, very expensive. We actually like the look of US index-linked much more. And there is a global inflation-linked ETF, which we do like the look of, which I think is perhaps a better bet than UK index-linked. We've got another question here. Do you forecast the pound bouncing back up in 2017, and which factors could cause this? That's a great question again, thank you. I think the short answer is that this is all bound up with politics and international investors' perception of how Brexit plays out and what sort of deal is going to be. I think it's going to be crucial, obviously, to how the UK market performs. I personally think that it's quite unlikely in the short term that the pound will bounce back. But of course, there are always two sides to this coin, and depends which currency you're looking at. Probably most unlikely is it for it to bounce back against the US dollar, which one would expect to be the hardest currency. But in terms of the euro, of course, there are European elections coming up, the French general election, April, May, which could cause some uncertainty about the euro, which would then maybe weaken against sterling. But I guess there is usually in markets a mean reversion, so one might expect the pound to overshoot down on the downside and then bounce back a little. Whether we've reached that downside yet is I think hard to call. But thank you. That's a very interesting question. So we've got another question here. I have several UK bank preference shares bought on a yield of well above 10 to 15% at the depths of the financial crisis. They have recovered well and now yield around 6 to 7%. I feel the time is coming to cash in on my profits, but where would I invest the proceeds as a pensioner to replace the yield with better security? Again, very interesting question, and well done for buying those bank preference shares at a time of great financial concern and worry. And that, of course, is always the best time to get into those type of investments, as well as as long as you know what you're doing, when you can pick up real bargains. In terms of investing the proceeds to replace the yield with better security, I mean, the answer is that unfortunately there's not much available at the moment that can replace that sort of yield and provide a secure capital base. I would say that the best bet to look at, if you don't mind equity volatility, is to look at a spread of equities that will give you a decentish yield, not at the 7% level, but certainly around the 4 to 4.5% level. And if you look at our website, we do run a managed income strategy, which is designed to provide a well-diversified equity portfolio that can provide an income for pensioners and other investors. So I think we're coming towards the end here. I think we've got two more questions, which I'm just going to run through quickly. One question is about investment trusts. Do you see any general trends in investment trust discounts or specific investment trust sectors? Just answering that very quickly, we've seen obviously investment trust discounts widen out quite a lot. And something like on our investment trust model portfolio, which we run a 10-stock model portfolio, discounts widened something like 5% over the course of 2016. So that's quite a wide movement. But you would probably think that if markets continue to pile forward, that those discounts might begin to narrow again. I haven't got any views at the moment on discounts in specific IT sectors, but I'd only say that equity income funds still look quite attractive, and the ones that are more focused towards the bond proxies, I suppose mainly the Invesco Perpetual House, are on some quite interestingly high discounts. We've got another question here, final question. Have you done your own assessment of worst case hard Brexit by reliance on WTO rules on equity values? I'm afraid I haven't. We haven't done that. I think it's really, if we're talking about uncertainty, that really is going to the depths of uncertainty, because we just don't know how things are going to pan out. But very interesting questions. Thank you very much, everyone. And thank you very much for joining us. And I do hope you'll join us again in what will be a series of investment webinars that we'll be putting on over the coming weeks. Thank you very much.